Hey, what's going on, everybody? This is Trader Jeff Moore, author of the book Trading Part-Time, and I'm super excited that you came to this free training. Right? This free training is on debit and credit verticals. How do they work? Now, when it comes to options, there's many strategies that we can do. Okay, I've talked about this before. You can buy calls, you can buy puts, you can sell calls, sell puts, or you can do these cool things called spreads. Two different types of spreads, okay, that I, teach the students in my basic option class. The advanced, or not the advanced, the more of the intermediate to advanced, it's credit spreads and debit spreads. Now that can sound confusing on the surface, right? Credit spreads, debit spreads. Credit means you get money. Debit means you pay money. Now, in my Basic Options University, a while back, I had a class and I went over with my students the credit spreads and the debit spreads. How do they work? It was a really long class, but I went into super detail. And again, it was so good. And because you guys have trusted me, I'm going to give you that lesson for free. Yep, for free, okay? So this video lesson is on credit and debit spreads, how they work, okay? And so also at the end, stick around, because what I want to do is I want to give you a 7-day free trial into my Basic Options University, okay? And so you got 7 days to test it out. Now, the key thing about that is not only are there tons of video lessons in the membership area, but we have a live Basic Options class every Tuesday. This is where students from around the world get asked me questions. We look at charts. We put on option trades every Tuesday, live. And if you miss a live class, it's recorded. So enjoy this free video on debit and credit verticals, how they work, and we'll see you at the end for that free 7-day trial into the Basic Options University. Enjoy the lesson.
So when it comes to options, we can buy, you guys know, we can buy the call. So just put in the chat. Let's see how good you guys are. So if we buy a call, what direction are we forecasting the stock to go? If we buy a call, what direction are we forecasting the stock to go? Up. Cool. You know, there's a lot of people that they just can't figure that out. Call. When we buy, up. Somebody tell me when I sell a call, what direction do I want it to go? When I sell a call, I want it to go. So that says up, and that says down. Sorry, get these out of the way. Yeah, you're right, down. I want it to go down when I buy a call. So if let's say that, for example, here, let's go this. Let's say that Nike, I'm looking at the 82.5 strike on this call. So if I buy the 82.5 call, okay, and Nike is at $80 right now, so the price of Nike is $80.44. I am what's called out of the money, right? We talked about this. Out of the money. Because in the money is anything that is under the price of the stock. So if I would have bought the 79 call, it would be in the money. So this is out of the money. Now, in order for me to be profitable, Nike has to move up above the 82.5 strike that I sold. So if Nike goes to $90, this option that I bought, the strike at 82.5, is now $7.50 in the money. So no matter what, this option has to be worth $7.50. So if I bought it at $1.61, it has to, because it's in the money by at least this, no matter what, be worth $7.50. So if I bought it at $1.61 and it's now $7.50, that means I have a profit of $5.89, which is $589. So when I divide these two numbers, right, divided by the 161, that's a 365% return. 365% return. Guys, even in cryptocurrency, that's hard. Okay, 300, and this just has to go up to $90. So if I'm forecasting Nike based on my technical analysis to go to 90, this is good, right? So this is going to erase. So that was the 82.5 call. But when I sell the call, if Nike goes up, so if I sell this call and I get, or let's say I get the $1.62, Nike goes up and now it's worth $7. I was given a credit of $162. I have to buy it back. I lose money. If Nike goes down, the calls go down. The job when you sell is you get a credit. So they give you money up front. When you buy, it costs you money. The job when you sell is to buy it back for less than you got. Okay? So let's go here and let's look at our credit spreads. So you guys know when we're bullish, we do a bull put spread. Okay? Bull put spread. And if you go to the, let's go here to, let me pull up something really quickly so that way we can kind of see. Hang on, I got windows opened up everywhere. Active trading, just plans. Let's go right here. Bull put spread. Okay. Here we go. Now, here's the deal. This right here is for the 3 green arrows bull put spread. But again, what I want you to understand is the key is when you're doing a bull put spread, somebody please tell me, oh, I just put chat, we want the stock to go up. No ifs, ands, or buts about it. Okay? Now, it can go sideways. It can go down a little, but we want it to go up. Because if I do the bull put spread, all that is that you're selling an option and you're buying an option at the same time. So, if, let's say the stock is, let's do this. Let's say the stock is in an uptrend, right? The stock is in an uptrend and it's pulling back to support. It's pulling back to support and you get kind of this hammer, okay? And then this is your, we'll do this and say that's your support level, okay? That's your support level. No matter how you slice it, when you do a bull put spread, you want the stock to go up. So if I see this beautiful picture and it's a higher low, then I can go in and I can sell a bull put spread. So let's say the stock right here is at $90. What I'm trying to do is I'm trying to sell a leg that's underneath support. Okay? So if the stock is at $90, okay, the stock is at $90, and let's say this support level right here is 88. I'm trying to sell a strike underneath it. So what I would want to do is, let's say I can sell the 87, right? Sell it. Now I want it to go up. But if I just sell the leg, it's what's called a naked put. A naked put means you have unlimited risk to the downside. Yes, I'm given a credit, but I've unlimited risk. So what traders will do is they'll come in and they'll buy a put underneath it. And it forms this. So this way we want the stock to go up, but if it falls, we have this as protection. So this now gives you a maximum defined risk, so a maximum loss. So people like vertical spreads is because it has a maximum loss. Even if the stock gaps down to 0, you have a maximum loss. That's a bull put spread. So if you really look at the rules, even though this has 3 green arrows, just go to your entry rules. They're pretty much the same. The only thing that you're going to substitute is right here. But this is pretty much the same, right? Expiration, 20 to 50 days. You want to choose the option that's closest to 35 delta. Now, this says you must sell below the 30-day moving average. Okay, so if you're doing a different strategy, you just swap that out to sell it below support. So the 30-day moving average or support. Okay, whatever's lower. You're looking for a 30% return on your money and a probability of 60%. We're looking to do $2 wide, so take this and substitute it in, right? That's what we're looking for on our bull put spreads. So here, Nike, I would say, okay, here's the put side. So I'm looking for a 35 delta or closest to a 35 delta. That's right here, okay? So that's the 77.5 strike. So what I want to do is I want to go look at the chart, Nike, and I want to say, okay, where is that 77.5? That's about here. So we want to see if it's below support, okay, or the 30-day moving average. I'll be very honest with you. When I look at this, I say, okay, here's resistance. That can act as support because you guys know when resistance is broken, it can act as support. Now, there's multiple support levels here. Look at this second support level. So what I like to do is I like to make sure it's below at least 2 levels of support, but I preferably want it to be below the 30-day moving average. So the moving average is down here at 75. So I would have to sell the 75 right here. The delta's 21. I know I'm not going to get my credit. Okay? We're looking at a $2 wide spread, right? That's what our rules say. Our rules say a $2 wide spread. But if we don't have a $2 wide spread, we go a $2.50 wide spread. So we don't have a $2, so it's $2.50. So we're looking for a probability of at least 60%. So look at this. That's a 76% probability that this trade is going to finish above 75. All we have to do to get maximum gain is Nike to, in 45 days, close above the strike of 75. So if it's at 80, it can still go down $5. Okay? That's good. But what's not good is I already know based on looking at this, we're not going to get our credit. Okay? $37 is our profit. Our maximum loss is $213. So 37 divided by 213, that's only a 17% return. Yes, that is great. And very few people would probably get 17% return. But that's not me. We want 30%. Because again, 30% is what I'm willing to take that risk. Okay, some fields are. Let's see here. Many stocks next fiscal year are trading sideways. Yeah, sideways. Okay. So that's our bull put spread. Now, we can do a bear call spread. So a bear call spread is when you're bearish, right? A bear call spread. So just like a bull put spread, right? When a stock is going up, we want to sell it. Well, when a stock is going down and it's at resistance, that's when we want to sell the bear call spread. So the rules, guys, are identical, except they're identical, they're the opposite, but this is what I mean by identical. We're still going to be looking for the 20 to 50 days to expiration. We're still going to be looking for 35 delta. We're still looking for the same percent. All this is the same. Okay, the only difference is the one, we want it to go up, but when it hits resistance, we want to sell because we want it to go down, right? But everything's the same. So if I go back to Nike, all I got to do is flip over to here. Now, we said closest to 35, so I would look at this strike right here. Now, I did say in the rules right here, suggested not the weeklies, but if I can get a good bid-ask spread, this is okay. They're a little tight. I mean, they're 10%. If I have 244 times 10%, that's 24. Yeah, it's a little too wide. A little too wide. So I'd probably go out here to the 45 days where it's a lot tighter bid-ask spread. But the bear call spread, it's the same concept, but it's just the opposite direction. So look, closest to 35 delta. Probability, 65%. So what that means is this right now has a 66%, because it's changing, 66% that if I sell the 82.5 call, it's got a 66% probability of finishing or closing in the next 45 days below my strike. The strike that you sell, after your forecast, is you want the stock to stay underneath it. And then you're going to buy, again, if I do this, and this is a $2.50, I'm going to buy the 80. So I'm going to, and again, everything looks good. 35 delta, I'll say, so look, the 82.5, so let's go look at the chart. So somebody tell me, the 82.5, which is about right up here, is that above resistance? Look at the hard right edge. If I sell this strike right here, am I above resistance? Yeah, I'm above resistance. So I'm happy with that. Okay? So this stock can go like this. It can even go up and back down. Hey, I've got a 66% probability. So I right click on the sell, go to the bid, sell, vertical. Right? We're selling the 82.5. Right? So we're selling the 82.5 and we're buying the 85. So this way, if it goes up and we lose on our short, we have protection. Okay? These give you defined risk. So let's look at our percentage. So now we're going to be given 73 cents credit. 73 cents, 72 is changing. So far I like everything about that. The spread is good. The probability is good. The 35, it's above resistance. So I can go in here and I can confirm it. The only thing I want to look now is, am I getting a 35% return on my money? So we take 72, we divide it by 178. 72 divided by 178, and bam, that is a 40% return. So you guys tell me this. Tell me this. I'll answer your question. Do you guys like this has a 66% probability of success? You've looked at the chart. It's above resistance. You're getting a 40% return on your money in the next 45 days. So 40% return on your money with a 66% probability of success, and you're above resistance. Is that good? You guys like that? I like it. I like it a lot. So the key is when you do your analysis on the chart, okay, and I do my analysis on the 1 hour chart, okay, so that way I can get even better credits. When I see, we talked about this yesterday, when I see this line start to cross, that's a good opportunity. If I see it cross here, just so you know, in full disclosure, look at Nike. Look at Nike. This is my real money platform. So Nike, I make 99.9% of my decisions off the 1 hour chart. Okay? So here's the thing. Do you guys see that Nike, okay, so Nike crossed. I missed that one because I wasn't paying it. I mean, it's not that I wasn't paying attention. I don't think I was looking at Nike then, but Nike crossed. Okay, right here, this cross. Now, I went sideways, but when it, and then after that, you know, once it crossed, this could have been an area, I was a little late. This could have been the area to sell. In this case, since it crossed to the downside, I'm expecting this to go down. I'm expecting this to fall around here. You know, I'm expecting this to go down, 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 eventually. I don't know how fast. So since I saw this cross, I'm now bearish. I'm bearish because the 13 crossed the 30. The purple line is the 13. This is the 30. It crossed. I'm bearish. But, there is a but. If you see here, and you can't see because my position's in it, let me pull out the paper money. Hang on, let me go to the paper money. See, it doesn't have all those lines. Let's go over here to the paper money. Sorry. By the way, the ES, tanking. So let's go here, and let me go to my get more money. Okay, here we go. So just kind of remember that picture. Nike. And we're going to talk about debit spreads after this, but I just kind of want to see since we haven't. So Nike, it should be a lot cleaner, the chart. Okay, cool. So I can do a little bit more with this. Plus the RSI is heading down, so even better. Okay, so here we go. This is a sideways mess. So when is a good time to do vertical spreads? When things are choppy or sideways. Okay, now, if I sell a bear call spread up here, don't get me wrong. I want the stock to tank. Tank. But if it goes sideways like choppy sloppy, it doesn't matter because remember, when we sell, somebody tell me, when we sell theta, which is time decay, does time decay help us or hurt us when we sell? It helps us. Because remember, we are given a credit. Time decay is like an ice cube that just bleeds away. The ice cube melts. So time decay, which is theta, helps us because our option is losing value every day. And if it loses value, that's good because we want to buy this back for less. Guys, write this down. Write this down and stick it on your refrigerator. Stick it everywhere. Here is the rule of thumb no matter what with a vertical spread. Okay? When you get 80% of your maximum gain, you buy it back. Our goal when we're given a credit is to buy it back for 80%. So we never let it go down to zero. Well, we do, but for you guys, no, because again, if there's 1 day left to expiration and everything's looking good, but there's a crazy event that day, you guys might be stuck buying the stock, and I don't want you guys to be stuck having to come up with $20,000 or $30,000. So here's the deal: whatever your credit you're given, you want to buy it back for 80%. So here's the thing. When I am shooting for a $2 wide spread, I'm looking for a 47-cent credit. So if I can buy that back, 0.47 times 80%. Okay, so 0.47 times 80%. So minus, hang on. Minus, sorry. So you want to times it by 20% the other way around. That's 9 cents. So if I can buy this spread back for 9 cents, I want to buy back. That's our goal. Okay, take our money and run. Now, here's another rule of thumb. Write this down. If you get 50% within 5 days. So when you put on the spread and you get 47-cent credit, if you can get 50% of that within 5 days, so you get in the trade, 1, 2, 3, 4, 5, this is down to, let's say, 20 cents, I always buy it back. Always. Okay? 50% in 5 days or 80% ever. Now, I got in this trade. So some traders, when they see this cross, that's when they'll recognize that as resistance, like I did, and they'll sell the strike above that. Okay? And look at it now. It went back up. No big deal because we don't have a stop loss. We just let it do its thing. And now look, it's back down. So I'm doing good. Okay? I want it to crash, but hey, I don't care. So guys, when you get this cross, just like the opposite, when you get this cross, you can recognize support, and you can go sell. Preferably, you want to sell it below that low. You can go sell a bull put spread. When it crosses, recognize resistance, sell a bear call spread. You guys with me? All day, every day. Bam. Just like that. And right now, I want it to tank, go back down, and then cross, and bam, sell me another bull put spread. I'm in Nike to the downside. Now, I'm also in UNH. Okay? Now, I kind of anticipated the break. I'm sorry, but sometimes I've seen these patterns so much, I anticipated the break. So I'm not saying that you should anticipate the break. But what I did see is I saw these two cross. So this is as close. So what did I do in UNH? Well, in UNH, I did the same thing. I recognized here, and I sold a bear call spread. Right? I wanted to go down, but I got my probability. Everything matched up. Okay? Everything matched up. For example, look at this. Look when it crossed. Guys, look when it crossed. Bull put spread. You think you would have got 80%? You dang right you would have got 80%. All day, every day. That's what we do. Right? We go to our charts now. This doesn't have this is entire watch list, so we just go through it. Boom. Right now, nothing. It's too extended. Okay? Right now, no. I want this to, well, let's see here. It crossed. So you could have, and again, remember though what we talked about. What is our setup? Our setup is this. This is what you want to see. You want to see the 200 moving average way below the 30. Okay? You want to see, again, you want to see this. Now, you want to see that distance, right? The distance. This is the setup. This right here is choppy. Choppy. I don't like this. Okay? Now, well, it's not, I mean, the 200 moving average is right here. I prefer it way down here. Okay? Like, let me go back to UNH. I mean, it's farther down here. What's another one? God, it's in my real money. Hang on. It is. Y'all got my watch list, right? I put my watch list in the university site. Alarm. Look at this. ALRM. Let's try here. ALRM. C. Okay. Somebody please type in the chat. Do you see the difference between that and that? Well, that's actually pretty good. Not that one. The one we looked at a minute ago. I forgot what it was. Dang it. Look at that, though. Do you see? This is real time. This is alarm.com. Was it Nike? Yeah, well, no, Nike was going good, and then it flattened out. But anyway, doesn't matter. Look at that. And if you look at the daily, look at this move. This is like straight up. So once the price, it's overextended extreme condition. This is an extreme condition to the upside. It's overextended. Price has a tendency to resort to the mean, which lots of times is this moving average. It's going to resort to the mean. Look how extended. you can see that over here. I don't need to look over here because if I'm looking over here, I'm probably not going to take any trade. Okay? What I'm doing is I'm catching these moves, this pullback. But I'm looking at the 1 hourly chart. So I see this, there's nothing yet. But, if this rolls over here, oh, I should have been red, I'm sorry. If that rolls over here, can't I sell my vertical when it crosses? So tell me, what vertical spread would I be selling over the next couple days if that rolls over? Will I be doing a bull put spread or a bear call spread? If that rolls over, will I be selling a bull put spread or a bear call spread? Is my microphone still working? Guillermo, thanks for answering. Bear call, bear call, bear call. Bearish, bear call, bullish. Percentage return that we're looking for, 30. Probability greater than 60. Here, we want price, again, look at this. Now it says must be below, remember this is a bull put. So our thing is it must be above resistance. Above resistance. Where is resistance? Oh, wrong chart. Resistance right now is up here. So if this stays resistance, I'm going to be looking to sell the 64, call, and buying the 66. $2 wide. Okay, as long as I can get my credit. And I'm confident with that trade. All day, every day. Now let's talk about debit spreads. I told you I wanted to introduce debit spread. Because the good thing about the credit spread, credit is we're given a credit. But if we sell the 150, this bull put spread, it can go like this, up, oh, down. Somebody tell me, when we buy a call, well, you have to tell me how to say it. We want the stock to move up. Do we want the stock to move up slow or do we want the stock to move up fast? If I buy a call, do I want the stock to move up slow or fast? Fast. Somebody tell me why. Why do I want the stock to move up fast? If I buy the call, why does the stock have to move up fast? Time decay. Theta, time decay, works against us. When I sell a call, I want the stock to go down. I don't care if it goes fast or not. Same with this. Bear call spreads, boom. Now, when we do debit vertical spreads, debit spreads. So first, the key thing is debit. It cost us, it cost us money. But this is another weapon in your tool bag. Debit spreads cost us money. Okay, but since it's a spread, it's got two option legs. Now remember, I'm just introducing this, so don't expect to understand this right off the bat. But I want to introduce you guys to this, okay? Because again, options, there's multiple ways to play the game. First of all, the key is play the game in paper money immediately so you can start to see how these things work. That's the first thing. So debit spread. Write this down for your notes. Bull call spread. That's the name of it. Bull call spread. So, bull put, now again, it's very confusing with the terminology, but that's okay. You'll get it. Bull put spread is to the upside. Bear call spread to the downside. So a bull call spread is a bullish strategy. Bullish. Okay? So, again, always write your notes. And don't think, oh my God, I'm never going to get this. Yes, you will. Strategy. Okay? Bull call spread is a bullish strategy. So, what do you think the other one is? A bear put spread. That's a bearish strategy. Okay? Bearish strategy. In a minute, we'll talk about why people do this. And again, this is going to take you a while to get. I understand. So let me just go here really quick. I just want to pull up any chart. Not the SPY. Let's go here to XLF. XLF is the financial sector. Okay. Oh, well, we'll just leave it at that. Okay, so let's go back here. So let's start to introduce you what this is. Okay, so a bull call spread is bullish. So obviously, we want the stock to go up, right? So let's go back to this one we looked at a minute ago. Let me go, this is alarm.com. Let me go 20 days. Okay. Look at this. Somebody see this? Okay. So, now, we got the cross right here. That's when it crossed. Okay? Now, you might have got into the bear calls. Well, no, you wouldn't have, because look at this distance. That ain't enough distance. One of the things, guys, whenever we're buying, this is a key. So let's do this. See this chart? When we're going to go to the downside, you want this distance. Everybody with me? You want this distance. Big old distance. The bigger, the better. That means it's overextended in a short condition, so it's got to resort back. But when you're buying to the upside, you want it to be above. The 200 moving average, guys, acts as a magnet for institutions. That's what this is. This is the hourly. So when I'm buying, I want it to be above. So if this was up here, the green, I would not do it. I will not buy to the upside unless it's above this. So right here, first of all, I would not have taken this because look, there's no distance. But I would have taken this because it's above and it crossed. So when I'm expecting the chart to go up, bull call spread. So let's kind of analyze that together. Now, remember, this was back here, so it's not going to be accurate now. Wish I could find one to the downside. I just don't want to spend all day on it. But let's just, again, hypothetically, let's just assume that we're back here, okay? Let's just assume we're back here. So I'm looking at this chart, and I would have, got my resistance right here. But again, it broke through. So whenever we are expecting the stock to go up, we can buy a call. That's one option, right? You can buy a call, but it's got to move. So if it doesn't move fast, we get crushed. So here's what we do. We go, if you're going to do a bull call spread, I'm going to write the rules for you guys. But again, we're going to be looking, as far as expiration, same. Okay, we're going to be looking for the same expiration, but there's going to be some differences down here. I haven't wrote the rules yet, but I want to just introduce you. So we go over here. You're going to look for that. Again, we're not going to do this one because what's the spread? Remember, it still needs to be 10%. So minus 10%, 23 cents. It's pretty close. I'd rather do this one, though. It's a little tighter. See how it's only 2 cents? So here we go. Number one is you're going to be looking on the call side because you want it to go up. Okay? And again, I'll tell you the logic here in a second. You're going to take this first strike out of the money. Not that one. So this one right here. This first strike out of the money. Out of the money means if the stock is at 80, 82 is the first strike out of the money. So it's the one that's I guess, not colored. Okay, everybody see that? Not colored. I got some questions I need to go back to and answer after I finish this. So it's this strike right here. So what I'm going to do is I'm going to sell the 82.5 call. So you're going to just go to the sell, right click, sell, not sell, buy, vertical, not sell, buy. First strike out of the money, right click, buy, vertical. Two things pop up. Now you need to make an adjustment, okay? Because the way this works is, this first strike out of the money is the leg that we sell, okay? Because here's the deal. When I buy a call spread, a debit spread, the stock's at 80, I want it to go up. So I'm going to sell that first strike out of the money. First, sell the 82. Sell it. So I'm going to sell the call. That's a bearish. But then I'm going to buy the first strike in the money. Again, I'll go over this many times. Don't worry. This is complicated. I'm teaching you guys something that took me like 4 years to learn. So there's no way in one class that I'm going to teach you. But you know me. I'll go over and over and over it until you get this. Don't worry. You buy the call. So you sell the first strike out of the money and you buy the second strike in the money. Now, what this represents, if I'm selling the 82.5, so let's say this. If I'm selling the 82.5 call, selling, that's bearish. Anytime I sell, I like to do that in red. I'm buying the 80, so that's what it looks like. Okay, I want it to go up. Because what I've done by selling the 82.5 is you've capped your gain. Because when you sell the 82.5, you have the obligation to buy the stock at 82.5. So when you do this spread, you are capping your gain. Okay, it's got a defined loss and a defined maximum profit. When I buy the call, it's infinite. It can just keep going up. Okay? But when you buy a vertical spread or a debit spread, you're capping your gain. So I'm capping my gain. But in here, I'm buying the call. I'm selling the call. So the distance in between here is my maximum gain. Don't worry about that because the thing will show you. All you need to know is whatever strike you're selling, as long as the stock stays above 82.5 by expiration, you're going to get maximum gain. So let me say this. I'm going to keep going over it again. So let's say this. If I sell the 82.5 call and I buy the 80 call and the stock is at $80, what I want to happen is the stock to go up. And as long as the stock in the next 45 days closes above 82.5, I get maximum gain. Okay? So, it's a bullish strategy, but I want it to go up. But because it's a vertical, it doesn't have to go up as fast. It can go like this, up, down, because time decay helps us. So look at here. I'm going to sell. See, now you got to change the legs. So I'm going to sell the 82.5 right here. And I'm going to buy the 80. First strike out of the money. Sell the 82.5, buy the 80. I know you guys are probably freaking out, but don't worry. It's the first time you've been introduced to this. Okay? Or you can just buy the call. Look, you can just buy the 80 call. But if I sell, so that's our rules. Sell the first strike out of the money and buy, in this case, it's the same as the other one. We're looking for $2 wide, or the $2.50, whatever. In this case, it doesn't have a $2 wide. So we're doing the $2.50. So that's why we're selling the 82.5 call and we're buying the 80 call. It's going to cost us money. Cost us money. But here's the deal. If I buy this 80 call, somebody tell me right now, if I buy the 80 call, how much is it going to cost me? Look right here. If I buy the 80 call, how much is it going to cost me? If I buy the 80 call, how much is it going to cost me? No, that's the 82. The 80 call. Right here. $262. It's going to cost me, remember that, $262. That's how much money it's going to cost me if I buy the 80. See, look, I buy the 80, 260, boom. Remember that, 261. But if I buy the vertical spread, buy vertical, I'm going to sell the 82.5, and I'm going to buy the 80. How much does it cost me? 114. What was the other one? 261. So it costs less. It costs less because the 80 strike is costing me 260. But I'm selling the 82.5, so I get $1.44 credit. I get that money. So the difference is what it costs me, because I'm getting a credit and I'm buying it. So basically what I'm doing is I'm getting this credit and I'm helping that credit pay for part of the cost. And as long as it just stays above 82.5, then I'm going to get maximum gain. Okay? Now, what we're looking, so we want it to go up. So if I look at the chart, let's go back here. And again, I can't get the same credit. When I see the cross, I'm still unsure if that's going to be a new trend, because remember, the cross is representing either a new trend or it's going to fake us out. So if I see this cross here, okay, it crosses. And let's say, remember we talked about that pullback? So it crosses, it goes up and pulls back. So kind of like this. I mean, this is the daily, but you can buy a vertical spread. So if I was looking at here and this went, it just crossed, I can wait for the pullback. Or, again, I'll be fully honest with you. I wish I could find, you guys know that when it crosses, let me see if I can find one that crossed. Just trying to find, let me go down and see if I can find one. Is it here? No. Just want to find one. We have to take what the market gives us. Let's look at that. Oh man, that's beautiful. Bank of America, that's setting up for this reversal. Hang on, I'm just going through our watch list. Well, we're not going to find it, but let's just assume, guys, again, this is beautiful. You guys know, this is the picture we're looking for, right? So let's say it crosses and then pulls back. We talk about it all the time. When they cross, we're looking for that first pullback, right? So when you get that first pullback, that first flag, so it crosses, price pulls back. That is your time to then put on the debit vertical spread. So it pulls back, then you can say, okay, it pulled back, it's testing it, now I'm expecting it to go up. See, when we do the debit spread, we don't need to pull back. As soon as it crosses, we can go ahead and sell the credit spread, because again, it might go like this. But for the debit vertical spread, we want it to move a little bit faster. So we want to make for a little bit more confirmation. So then in that case, as soon as that happened, I could go over here and I would say, okay, first strike out of the month. Again, remember, the prices are different. I mean, we get it. So the first strike out of the money, I'm going to buy a vertical spread. Okay, buy a vertical spread, which means I'm going to sell the 65 call. You're going to have to watch this recording, guys, over and over again. Sell the 65 call, Do we have $2? We have $2.50, so then I'm going to buy the 62.5. There we go. That's my trade. And as long, in this case, as long as it just goes, all this has to do is go from 63.43 to $65. So it's only got to go up $1.57. Now, I would love for it to go up more, but that's all it's got to do. If I buy the call, it's got to go up a lot. Now, what are our rules and what are we looking for? And again, I'm just introducing. We're going to write rules, but I just wanted to introduce you to debit spreads and when to do them. When do you do the debit spread? You do the debit spread when you get the cross and you get the pullback. Look at that. Cross, pullback. So whenever it crosses and you get the pullback, you can do a vertical spread as soon as it crosses. Sell your vertical below support if you get the credit. But when it crosses, then you can put on the debit spread because it's more forgiving. Okay? What are our rules, just so you know? When we buy a debit spread, we're looking for a 100% return on our money. Does everybody like that? A 100%? And I'm definitely not joking on this one. 100, we're looking for a 100% return on our money. So, here's the deal. Your maximum loss, look, let's do this. This is a $2.50 wide spread, right? But it's going to cost me $1.22. So watch this. When I click over here, remember, when you buy an option, the amount of your maximum loss is what you pay for the option. Okay, your maximum loss is what you pay for the option. So if I'm paying $123, my max loss, well, in this case, is $122. Okay, so that's what you pay. Look at my max profit, $128. So my maximum loss is $122, and my maximum profit is $128. And in order for me to get maximum profit, all this stock has to do, if I am selling the 65 call, and now this says Citibank, dang it. Look here. Citibank is at $63.35. As long as Citibank finishes above 65, so guys and gals, all it has to do is basically go up $1.70. If Citibank goes up $1.70 and then does nothing, as long as it closes or finishes above 65, I'm going to get maximum gain. And if you divide 128 by 122, that is a 104% return. So what I'm telling you is if Citigroup goes up $1.75, that's it, and closes by expiration above my 65 strike, I will get a 104% return on my money. All it's got to do is go up $1.75. If I buy the call, it's going to have to go up 10 or 15 points for me to get a 100% return on my money. You understand? I mean, again, I'm first introducing you, but does that pique your curiosity? $1.75 to get a 100% return on my money with a defined risk? Oh, by the way, look at the break-even. The break-even is $63.72. So somebody tell me, if the stock right now is at $63.41. I'm just looking down here. It's changing. And my break even is $63.72. Break even. If this stock goes up 31 cents, as long as it closes above 63.72 by expiration, 31 cents, I break even. So would you rather buy the call and get crushed by time decay? It has to move, or you do the vertical spread, and if it goes up 31 cents by expiration, I'm going to break even. And all it's got to do is go up $1.75, and I'm going to get 104% return on my money. 104%? When do you do those? Simple enough. When you see the cross and the pullback, you look to see if you get your credit. Because here's the deal. You have to get 100%. So let's say this was going to cost me, and it's not going to cost me this, but let's say it cost me $1.43. When you hit confirm, see, max loss 143, max profit 107. That's not 100%. So here's what I'm going to do. The market makers like to screw you. So what I'm going to say is, hey, listen, if you give me my credit, I'll get in the trade. If you don't give me my credit, I don't want in the trade. What's my credit? Well, here we go. If this is a $2.50 wide spread, that's what the spread is, right? Half of that is 125, right? Y'all with me? So, I know that with a $2.50 wide spread, the most I can pay is $1.25. That's the most I can pay to get my 100% return. See, look, max profit, max loss, 100% return. I will accept nothing less than 100% return. Nothing. When I do this spread, I want the market maker to give me 100% return on my money, and I want to see this cross, and I want to see this pullback. And then I'll take that trade if the market maker gives me. Look at my, and it gives 100%. And as long as the stock goes up, whatever, 30 cents, we break even, and $1, I get 100% return. So guys, here is the key. How do you position size? If my maximum loss is 125, remember, it has a maximum loss. Let's say I'm willing to risk $500 at this trade. Then what I can do is I can go, oops, I'm going to buy 3, click it here, then I'm going to look at it. 375, okay, 375. I'm willing to risk $500, so I can check a little more. Let me do 4. Boom, there you go. 4 contracts, max loss 500, max profit 500. So as long as this stock goes up like $1.75 in the next 45 days, I'm going to make $500. Most I can lose is 500. And guess what? If it goes up 30 cents, I break even. So theta works for you. Theta doesn't hurt you. Tell me, that's what the debit vertical spread is. And when do we do it? Easy. Cross, pullback. Every chart you look at. Costco, guess what? Not yet, but what if? What if on Costco, this hooks up? It's supposed to be red. Sorry. What if that hooks up right here? Can I sell the vertical spread? Sell the vertical spread if I get the credit, the cross, and then if price pulls back, I can look to do the debit vertical spread. Same here. Again, I wouldn't have done this. Why? There's not enough distance. Whenever I am selling, I want the stock to drop like a rock. If this drops, it's going to drop like a rock. This is my opportunity. So to the downside, we would do a bear call spread on the cross. or wait for the cross and then the stock to hook up, right? And then we would do the bear put spread. So just like we did a minute ago, but it's the other side. It's the first strike out of the money on the put side. So you go right here. Buy vertical. Now, if you look at here, look at these. This is an expensive stock. So the strikes are $10. Doesn't mean you can't do it. You still got to get your credit. Run the numbers. So if I want it to go down, I sell the put. Again, for your notes, we're going to talk about this a lot going forward because this is what I like to trade all the time. I don't buy stocks, man. I'll be honest with you. I do options. So if I'm expecting the stock to go down, I can sell the 260 and I can buy the 250. Remember, you buy the first strike in the money. So sell the 260, buy the 250. So sell the 260, buy the 250. There we go. That's my protection. It's a $10 wide, right? $10 wide. Credit. My bad. Other way. Sorry. I want the stock to go down, not going up. So the 260, so you're going to buy the vertical. I did everything right, just the one leg. So you're going to sell the 260, and then it's going to show red, right? But since we want it to go down, we're now going to do the first strike in the money. So if you look at over here, you're going to sell the first strike out of the money, buy the first strike in the money. When you're doing the put side, you sell the first strike out of the money, you buy the first strike in the money. Because remember, you want it to go down. So the leg that you sell is the low leg, you buy it. So a minute ago, I just had to flip the numbers. So I'm going to sell the 260 and I'm going to buy the 270. Boom, there we go. So this position would cost me $424. If I bought the put outright, it would cost me, I have to do on the ask, it would cost me $520. Now somebody tell me, if I buy the 260 put, the stock right now is this is a very important question. The stock right now is at 266. If I buy the 260 put, this stock has to go down how much money for me pretty much just to break even? If I buy the 260 put and the stock is at 266, how much does this have to go down for me to basically break even? $6. It has to go down $6. Yeah, I mean, because you're going to get a credit, though. But roughly. So here's my thing. It has to move. And it's going to cost me $5.25. So $525. Look at this. If I do the vertical, it's going to cost me $425. So this is going to cost me $525. This is going to cost me $425. And look. Maximum loss, maximum profit. Again, I like to. You would not be taking no bull put. You wouldn't be taking no bear put vertical right now, debit, because again, the chart doesn't show it. But if the chart was to roll over, you'd want this to be equal because you want 100% return on your money. But look, just right now, look at the break even. The break even is 265.75. If the stock is at 266.21. and the break-even is 265.75, that means the stock has to go down about 50 cents for me to break even. The other way was like $6. Well, I mean, it'll be a little bit more because you get credit, but $6 at a minimum. This is 50 cents. I have a lot more leeway when I do the debit spreads. I don't have to be as right so fast. As long as it just goes down and eventually, in this case, it would have to, by expiration, be below 260. So 6 points on a $266 stock? But again, you wait for your setup. You don't just blindly take this. So like here, look. This is UNH. I'm in a bear call spread. Okay? So what I would like to see happen for me to do your terminology, I know there's so many terminologies, but in this case, a bear put spread, which is bearish. In order for me to see that, I want to see this cross, right, more defined, and price to come down, hook back up into these moving averages, right? That's when I'll look at taking the bear put. And then I'll run the numbers. At that time, I will run the numbers. And my numbers are, I'm going to sell the first strike out of the money, buy the first strike in the money. I'm going to run my credit. I'm making sure I get 100%. And then I'm willing to take that risk. Okay? So anyway, I threw like 5 years worth of information at you in like 35 minutes. So don't expect you to understand this all. But the good news is, this is what I'm trading. So you'll be getting, the alerts. And not only that, when we're in class, I'm going to be talking about this every single day. Every day. And if you guys come to me with stocks, then we can look at them together. Analyze them together. Okay? But the bottom line is, you have credit spreads and debit spreads. Okay? And there's differences. More forgiving, a little less, or you can buy the calls. So again, that's what options is all about. Buying calls, buying puts, selling spreads, buying spreads, and understanding the difference. But at the end of the day, I put these on when my chart suggests, here is the setup. Take a mental picture of the best looking setup you could ever imagine. Right there. That's the greatest looking setup to the downside. Doesn't mean it's going to work, but this setup is what you look for. Then you wait for the cross. You don't know if the cross is going to work right away, so you can leg into it with selling a spread. Then if it proves that it works in your favor, you can buy the put or do the spread. Okay?
All right, so what did you think? Awesome, right? Just the main keys to remember is the credit spreads or the credit verticals, bear call, bull put, you're given a credit. It's a high probability strategy with a defined risk and a defined amount of money that you can make. Wonderful strategy. On the debit strategy, you pay to get into that trade. But again, it's got a defined risk and a defined profit. Awesome. I love talking about the vertical spreads. They're a high probability. Some people don't really like just buying calls because they're a little bit more aggressive. If that's the case, do your spreads. All right, so thank you so much for watching the free training. And because you did, what I want to do is I want to give you a 7-day into my Basic Options University for free. So you have a 7-day free trial to take it out. So what you want to do is you want to go to the link below, click it, enter your information, and you're going to get 7 days for free. If you want to continue the class, do nothing. We'll bill you on the appropriate date. If you don't, let us know and we'll stop. So you have nothing to lose. So just click the link below to get access into my Basic Options University for free. All right, everybody, this is Trader Jeff Moore, author of the book, Trading Part-Time, and we'll see you in the Basic Options University.